Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for a very wild week ending August 2nd, 2019. And all I can think of when I look at the market this week is, wow, risk happens fast. But it was actually there all along. We'll talk about that in a little bit. In the meantime, S&P down 5 days in a row, lost 3.1% this week. Small caps lost 3% this week. The Dow Industrials lost 2.6%. The NASDAQ, also down 5 days in a row, lost a whopping 4% this week. I don't know if you noticed it as I was going through the charts. This is a 50-day moving average. All the averages dipped below this and closed above it, except for small caps. They went down to the 200-day moving average and closed below the 50-day there. Here's a 5-minute chart of the S&P 500 on the week. This is Monday, Tuesday, Wednesday, Thursday, Friday. Look at this 36 hours of just manic trade, dropping almost 2% here. Next day up almost 2%, then dropping 3% over here. Absolutely nuts. So this was the worst week of 2019 and really the worst decline here since the end of December. This really nasty sell-off. As far as S&P sectors, it was just as ugly. So you have 11 sectors, about 7 of them are cyclical. All of those were down at least 3%. Some of the uglier ones were financials. Now, financials the last couple of weeks were pretty much the only hope I had for the market moving higher at this point, and specifically small caps. Financials had looked good the last couple of weeks. They got absolutely hammered with the banks down 5%. The technology sector, one of the worst performers, down 4.3%, with semiconductors down 6.3%. And then we have the consumer discretionary sector down 4.4%. As a matter of fact, of those 11 sectors, only 2 closed higher. Both of them were defensive, the utilities and real estate over here. I strive to bring my clients, my subscribers, look at the market that is not just about technicals. That all matters to me, but what I strive to bring is some context and the tone and the character of the market. For instance, if we go back to this record high over here on July 15th, I think I talked about this in my last video, it was absolutely minuscule, 0.003%. This daily range was 0.2%, so that is the smallest since all the way back here, September 19th of 2018. That was the final S&P high before the market did this. Let's take a look at the volume. That was the lowest volume that the S&P has seen since Thanksgiving of 2017. So we've had a lot of half days since then. It was lighter volume than half days, like July 4th, before July 4th at Thanksgiving. So, CNBC goes on about these new record highs that are just fractionally up on horrible volume. It just doesn't matter to me to say new record high unless there's something behind it, unless there's some price strength behind it. Now, I don't mean weak in terms of price gains or anything like that. I'm talking about the internals, what the trade looks like, the tone and character of the market. So this is the S&P on a 30-minute chart since July 1st, and it has gained. It's made higher highs and higher lows, which means the bulls are in charge, but it has done it on some really weak internals. Small caps over here, they spent the entire month going sideways, tried to break out a couple times. Here we have a failed breakout. Those lead to fast reversals more often than not. Look at this. 7 weeks of gains wiped out in 3 days. And where did all of this happen? At the top of this broadening range that I've been talking about. The trend line was right about 30.30. And let's take a look at here what the S&P did. And there's the high, 30.2798. Now, that's not to say that it's because of the broadening top, but the broadening top represents basically chaos, unintelligent sponsorship in the market. All of this did not happen without warning, just out of the blue. Remember where we came from, selling off in May because of tariffs and weakening data, and remember why we went up in June, or what the catalyst was, which was the market started pricing in a rate cut for this July meeting. As the market's been going higher here, it's been ignoring all kinds of bad news. The week before last week, the Department of Justice announced a antitrust probe into basically Facebook, Amazon, and Google, right? Market did not react, had no reaction to that. Chicago PMI was out this week, and ISM both missed. ISM was the worst in 2 years, did not bother the market. So all these signs of risk or of growth slowing or antitrust probes, the market doesn't care, it's buying it. It's bad news is good news. That's what's been going on this entire month. But there have been some hints. So I think I picked up on this the last video I did. I think it was about 2 weeks ago. There were some trend breaks recently in sectors. This is a 30-minute chart of the technology sector, XLK. This is the end of June into July. A ascending wedge. Now, this is a bearish pattern as price narrows in this wedge, but they're difficult to trade. Sometimes they break, but a lot of times they go up and back test this trend. And once this broke a couple weeks ago, I pointed this out. That's basically what it did, back tested this trend. We had other sectors that broke too a couple weeks ago, like XLE. This is the energy sector. So this is that June-July uptrend right here. That broke, back tested, and now this is actually in a downtrend. Early this week, we had a few more sectors that broke trends. If you want to get the sense of the tone and character of the market, follow the trend, the price trend. This is a very strong price trend. It's going up. It's respecting these trend lines. This is a trend break. So you have a big change in character here. It may not be in every single sector or the major averages yet, but it is telling you something in advance. This is something anybody can look up. Anybody can get this information. This is market breadth, okay? So this is the S&P 500, and this is all of the NYSE listed stocks making either new 52-week lows in this case and highs in another. I'll show you both. This is the S&P 500 daily chart and the rally from 6/3, June 3rd. So that's the rally from right here after this May sell-off. So we're going to break this down. And what I have here is the new 52-week highs, where each consecutive higher high the S&P makes, these are making lower highs. That's less and less participation. So you may say, well, it doesn't look like that big of a deal to me. But remember, during this period, the S&P made at least 6 new record highs, okay? And each one, you saw less and less participation, fewer and fewer NYSE stocks making new 52-week highs. Here is new 52-week lows in the NYSE composite. Okay, so here's this rally going up, and what these should do is go down. They should fall off. The higher the S&P goes, the lower these should go, the sloping down. So look, when we get right about over here, early July, what's happening? You're seeing more new 52-week lows. This is the problem. So that's something easy anybody can look up. Now, this is something most people don't have access to, only my subscribers, my clients. This is a proprietary indicator, 3C here in orange. This is the DIA, the diamonds for the Dow ETF. And the trend that we have been seeing, that I've been seeing for at least the second half of July, the last 3 weeks, is that 3C has been divergent. So you can see the Dow here was pretty much kind of going sideways over here since about July 15th, right where we had that S&P new record high on abysmal volume and a teeny price range. And 3C is negatively diverging. This was a leading negative divergence, one of the uglier ones. And over the last week here, as the Dow is going sideways, it is not doing anything. It is negatively divergent, as you can see. And here we go into this week. Here's the SPY, the SPY. This is coming down out of May. So 3C is moving down in line, even leading lower with this decline in May. And here it is in early June. This is where Powell made that dovish pivot and the machines bought everything. So look, this was a strong rally in early June. We get into July here. There's July 1st. And 3C is negatively diverging. Draw a trend line across here. It is going down while the market is making higher highs. If we go to QQQ, same time frame, same thing. Good strength over here, starts to dip here a little bit, but not a problem, makes a higher high here, and really since the start of July. So we've been seeing this really the last 3 weeks on shorter term charts, but pretty much since the first week of July. Here it is for IWM, the small caps. Again, good confirmation in early June, strong rally, and here's that lateral range. It didn't do much, it kind of went sideways, but as the IWM tried to break out of this range, you can see it's not making higher highs with price, and there we have it come down. And to me, one of the more interesting ones was volatility. This is VXX. Okay, so we started seeing a positive divergence here. This was the prior week, the 24th of July, and saw it again on Friday, right here at this basically 2140, 2150 level. You can see it here, and it just ripped higher. I mean, you have 3C leading price higher. So you see price here just going sideways, 3C is moving higher, and confirms over here. We got a little bit of a negative divergence into Friday, but this, again, another warning in money flow, not just in the averages, in all of the averages, but in volatility too, saying the same thing. Here's VIX, by the way, so those positive divergences were right here, the 24th, right here, the 26. So from here, where those positive divergences came in, VIX gained 46% over the last, 1, 2, 5 days. The safe havens that have really looked good, like gold, this is GLD, daily chart, big ascending triangle, a very bullish price action here and very bullish volume actually. As gold advances, the volume is advancing. As it consolidates, the volume comes down. So here it is. I mean, a big move. Didn't quite break out for the week. If you look at something like this and then you look at all these other things that we're just kind of covering in the averages, gold looks a hell of a lot better than being long stocks. And then the other one that we've liked for a long time, TLT, I really didn't think it was going to get this big of a move this week. But look at this. I mean, just monstrous move on just fantastic volume. Look at that volume. So S&P lost about 3%. TLT gained almost 4%, 3.8%. It's like, to me, you know, when you have a constructive trend, constructive volume like this, where do you want to be? And something that is moving constructively or something that is moving up but just doesn't have a lot of strength. You don't see these kind of volume trends in any of the averages. Here's the Aussie versus the US dollar. I've talked about this a lot in the past. I'm not going to do a whole primer on it. Look what was happening the last 2 weeks here. The Australian dollar was, among other things, you know, there are country-specific issues, but among other things, it was showing this deflationary trend restarting the last 2 weeks. You could say the Australian dollar was discounting all of this data that was coming in that stocks were ignoring. And then this week, all that changed, and the stocks priced in that bad data that this had been reflecting for 2 weeks. So we're going to look at what the Aussie did over here, what it told us before stocks went down, and what it did here before stocks went down. So this is what I'm talking about. Let me just zoom this back a little bit so you can see. This is like the last week. Look what this Australian dollar is doing, making lower lows versus itself over here. And watch, it just keeps going, going, going. Stocks are still trying to go higher. And finally, stocks revert down to what the Australian dollar had been saying about growth for 2 weeks before this happened. So I want to show you one final thing. Market ignored this. I noticed it back here in April before this decline, and I noticed it again this week. So what were the two main reasons the market went down this week? One, Federal Reserve. The other event, Donald Trump tweeting out that he's going to raise tariffs by 10% on another $300 billion of Chinese goods. The market lost it. You might say, well, who could possibly know what was going to happen with the Fed? Nobody. That's true. Who could possibly know what was going to happen with this new round of tariffs? There was some evidence, and I'll show you. The market just ignored it. This is the SPY. This is April, the tariff decline over here in May. Here's the June rally. Here's the tariff decline this week. Remember in April, I was saying, look, something is not right. These talks are not going well. Volatility's showing way more strength than it should. And then, for the first time since 2017, North Korea fired off some missiles. North Korea depends on China. So if you watch what's happening with North Korea, it's a good indication of what's happening with trade talks. So North Korea fired off missiles before we even knew the trade talks collapsed. Then over the weekend, trade talks collapsed, and Trump put on tariffs over the weekend, started this. Now let's look at this week. Market just ignored this. North Korea firing off missiles again. Trade talks started this week, Tuesday. Trade talks are supposed to be 2 days, Tuesday. They only last a half a day. They fail. There's nothing that comes out of it. North Korea is firing off missiles again. First time since back here in April. Here's the failed talks announced. Here is the Trump tariffs announced. So if the market had been paying attention and not just focused on the Fed and Fed cutting rates, it probably would have noticed this. North Korea firing missiles as talks fail, and right before Trump puts on new tariffs, both times here and here. I hadn't opened a new short since back here, and I closed it over in here in May. I do have some longer term shorts that have been accumulating, but I actually did go ahead and short the SPY just about a month ago. Actually, I bought puts. So I bought puts here for a different reason, but among the reasons that I bought it was the weakness in the market, but I was thinking something else might happen first and we'd get a little correction. I wasn't looking for a big move. So I did not cover that position because all through this time, nothing looked good in the market. It didn't look like, horrendous, but it didn't look good. It didn't concern me. And I still had lots of time, at least several more weeks on those puts. And then we come into last Friday, and I added to those puts right here last Friday. Notice I do it into price strength, not when the market's breaking down into price weakness. And then I sold them over here. I made about 45% for the month. Those puts could have been a double for me if I had held them one more day. It would have been a double on my money for the month. Now I want to show one of the trade that I put out in recent weeks, just because it's interesting in that it reflected this defensive tone in character. Here's a daily chart of XLRE. It's the real estate sector. So most people want to buy the FANGs, or they want to buy technology or something, high flying. But the real estate sector has been jamming. It's been making higher highs, new record highs, well before the S&P. These are defensive sectors. So I put out a trade idea, a long trade idea on July 24th right here, and again on July 26th right there. As it came down to this low, 3C started exploding higher. It was showing buyers coming in here. Here it is. It doesn't look like a huge, fantastic trade. It doesn't look that exciting. Let me show it to you another way. This is a 15-minute chart of the S&P 500, and I have XLRE in white. I have them normalized from July 15th. So the long trade recommendation was 24th and the 26th over here. And look what this sector did versus what the S&P did. So sometimes it's not just about making money, it's about keeping money. From the entry point, if you were long XLRE, you made 2%. If you were in the S&P, you lost 3%. So was my XLRE long about some foreknowledge that I knew that trade talks were going to collapse and that the Fed was going to disappoint the market? No, I don't know that. What I knew was, out of all of the major averages, the NASDAQ, the S&P 500, small caps, out of all the 11 sectors that I was looking at, this was the only one that had really solid 3C charts down here at the low. That's why I mentioned it. So it seems like to me, somebody else, a big player out there, felt the same thing or was moving more defensively in anticipation of this week. That again just goes to tone and character of the market. Stuff you can't pick up on moving averages, a MACD histogram, RSI, whatever you want to call it. Those are the things, the intangibles that you cannot get from technical indicators. Okay, so heading into next week, you have the S&P down 5 days in a row. That's short-term oversold. Friday morning, as the market was coming down, I sent out a note to my members. I said, I think it's going to hold here at 29.13 to 29.14. Low of the day was 29.14.11. You also have this 50-day moving average. I did not see buyers coming in here at the low. What I saw was sellers abating, sellers stopping their sell activity. So what I saw basically at 11 a.m. here on Friday was the sellers stop. I didn't see buyers come in, although the market did close off the lows. I think this is an important level near term, but 2,900 is crucial that the market holds that. And I would think that it will, and it will bounce probably into the next week. For small caps, I think this 151 level is really important. This is the June low, so it's retraced a lot of this because it did nothing the first 3 weeks of July. Not only do you have that level there, but you also have the 200-day moving average at 151.22. I have this trend line drawn for the SPY. It's very generous in that there's only 2 points of contact, but we're right here about that level where really it needs to bounce at this point, and I think it probably will into like the next week. What you generally see when you get one big break like this is that it's a first leg. So for instance, if we go back here to September of 2018, here's a first leg down, a bounce, a consolidation, a second leg down, or you can look at it in even bigger terms, a big first leg down, a big bounce consolidation, a second leg down. Even over here in April, one leg down, bounce consolidation, second leg down. So this is what I think is probably going to happen right at this area. Moving to a 60-minute chart of the S&P 500, what I would like to see is a bounce back up to this 3,000. Now maybe we test 2,900 first. I don't know that we'll get up to 3,000, but that's what I would like to see. And if things go the way I would suspect they're going, just based on what we know right now, I would anticipate getting short here again. And I'm really trying to build a longer term position at the top of this trend line of this really large broadening top. But I certainly don't want to be shorting a market that's down 5 days in a row over 3% and really is at some technical levels and psychological levels of support, price support, and moving averages. If you look at this decline in April or into May, we have a lot of price volatility, so these bounces can be very sharp. I mean, over here you have a 0.75% decline. Over here you have a 1% move up, and then we start moving back down again. So I would expect to see some really strong upside volatility as well. A lot of traders don't like to short into that kind of stuff, but I personally don't like to be shorting into this weakness. I like to short into strength, and I don't see any reason to be long this market. But ultimately, I think the market will probably take this trade war tariff escalation as initial good news in the next week or so, trying to discount more rate cuts in September, which I absolutely think is going to happen. I think we are on a rate cutting cycle now. Check out my video a couple weeks ago. I addressed this, that the market was buying this rate cut cycle and it was happy about it. Should it be? Take a look at what's happened historically. So that's what I'm looking for next week. Hopefully, I'd like to see a bounce up to 3,000 and see what the tone and character of the market looks like there and get short again. Have a great weekend, everybody. I'll see members on Monday.